Financial market volatility was more confined to emerging markets in August, but could well be set to broaden as we move into September. As a consequence of emerging market volatility, the US dollar remains well supported, and further gains over the short term look plausible. There is a heavy schedule of important events for the financial markets to deal with this month, with numerous risks that could prompt a notable deterioration in investor confidence. Of primary focus on a global scale is the direction of US trade policy by the Trump administration. The US and Canada will resume trade negotiations on the 5th of September, after failing to reach an agreement at the end of August. On the 6th of September, the public hearing procedure on introducing additional tariffs on China imports under Section 301 will end, opening up the potential for President Trump to announce the implementation of tariffs on $200 billion worth of China imports. A failure to reach a deal with Canada and a decision to implement tariffs on a substantial portion of China imports could be defining moments in shaping market participants' expectations of the impact of US global trade policies. Up to this point, trade uncertainty has had very divergent consequences for financial markets. Since the start of the year, the MSCI Emerging Market Equity Index has declined by close to 10%, while nearly all major developed markets are also lower on a year-to-date basis. However, the S&P 500 has advanced by close to 9%. We are very dubious of this stark divergence in equity market performance continuing for much longer, if the global trade conflict worsens from here, with US equity markets much more vulnerable to a sharper correction lower. While global trade uncertainties remain elevated due to President Trump's actions, Europe has additional uncertainties with the currency crisis in Turkey, Italy budget uncertainties, and Brexit. Brexit in particular has now entered a crucial stage. Parliament resumed on the 4th of September, with EU-UK negotiations now ongoing on a daily basis. Following Boris Johnson's newspaper article attacking the Chequers deal, there is certainly a risk of a leadership challenge taking place ahead of the Conservative Party annual conference, which begins on the 30th of September. But do the hard Brexiteers have the numbers in Parliament to oust Prime Minister May? That remains unclear. Certainly, the statement from Downing Street that Prime Minister May offered serious leadership and a serious plan suggests renewed government confidence in obtaining the required parliamentary support for the Chequers plan. All of these uncertainties point to further dollar appreciation. However, a note of caution. On the 3 previous occasions speculative long dollar positioning has reached these levels, a quick reversal has followed. The dollar's performance over a longer time frame is unimpressive. Since President Trump's election victory, the dollar is nearly 3% weaker, a period covering 6 Fed rate hikes and the largest combined tax and fiscal stimulus since the 1980s. That suggests to us, despite the recent positive performance, that all is not well for the dollar. If market volatility does pick up further, year-to-date G10 currency performance suggests the traditional safe haven currencies, the yen and the Swiss franc, would be better options than the US dollar.